Ladies and gentlemen, Jonathan Ellis, Sandalphon Capital. Jonathan, thanks so much for carving out the time. You're a busy guy these days.
Thanks, Tim. Nice to be here.
I really appreciate it. So funny story for the listeners. We met back in 2016 when you were starting Sandalphon Capital. I was out on my own. A lot of the listeners know my story about leaving corporate America. And I had a little co-working space right across from the merchandise mart. And Jonathan was nice enough to come my way and meet me. In the office space that I had sat one person, and the conference room was booked. And then Jonathan and I had a nice coffee meeting, basically sitting knee to knee. It was a little bit awkward. I don't know if you remember that at all, but I sure do. And I was like, I got to get some bigger space for sure. But thank you for continuing the relationship after that meeting, for sure.
Yeah, I mean, so this won't really come across, on audio or video, but I'm 6'6". So when my knees are knee to knee with you, I mean, my knees are basically in your face.
I was a little intimidated, I must say. I was a little intimidated. You were very nice. You were very nice. It was awesome. So I remember you just starting Sandalphon, and it's grown since then, and your presence in the tech ecosystem has grown since then. But just for the listeners that don't know Jonathan, maybe just take us through your backstory and how you got to venture capital.
Sure. It's a little unusual, I guess. I started off my career in the UK doing middle market investment banking. Got the chance to come to Chicago. I was meant to be in Chicago for 6 months, and 13 and a half years later, I'm still here. I would say be careful what you say yes to, but no regrets. And I spent most of my career prior to Sandalphon doing middle market private equity and debt investing. So we looked at B2B SaaS companies, especially finance companies, commercial real estate lending. And around 2014, I started getting interested in angel investing. So that included small checks on AngelList. I started doing some checks in Chicago. I used to sneak out of the office to go to pitch events and networking happy hours to sort of get to know more people, and sort of got really pulled into what was happening in the Chicago tech ecosystem. I kept hearing again and again people saying that there wasn't enough early stage capital in Chicago. Thought that was kind of crazy. I've come to appreciate, I think, historically, like why that was the case. And wanted to do something about it. I always wanted to start my own company. Didn't have one good idea like some of the founders we back. Had always been an investor, and it just seemed like this was the perfect sort of combination of what I'd done historically, the interest in like the learning curve I was on, and the opportunity. And so we started Sandalphon in 2016.
So what you were doing before, my understanding of private equity, real estate investing, especially debt investing, like these are more mature companies than like the angel crowd. What drew you to the angel community and the early stage stuff? Because obviously I would imagine, you have a lot of experience in finance and spreadsheets. It's probably a little bit more risky of an investment. So what drew you there?
Yeah, I mean, I spent my whole career as a generalist, so I was always looking at new businesses and new markets, and my job was to get up to speed, like, know 80% of what an expert knows within a few days, which is usually pretty intense. But I'd sort of seen a lot of things and like knew enough to be dangerous. And then, we were typically looking at anything north of sort of 10 or 20 million of EBITDA or cash flow, up to, I think my biggest one was like $1.5 billion. And you're looking at historical financials and KPIs. It's a little bit boring. The business is very mature. It's fairly predictable. You can build a cash flow forecast out 5 or 10 years, and it's not going to be exact. But what I was finding though was on the private equity side for a few years, had been part of like helping create equity upside and thinking strategically around how to do that. And then I spent a whole bunch of time as a lender, where you have capped upside, but you have to really understand the risks. And I was like, okay, this is like, the early stage stuff is interesting because, if you can avoid the like obvious mistakes, the asymmetry of early stage venture, the winners sort of take care of themselves a little bit. But it's just a chance to sort of, parlay what I learned. And then to be honest, my old employer, they did put up with me for 10 years. I like to, I did the analysis, but I often like to go with my gut as well. And early stage, you have to do that. So we'll look at whatever we can and be as rigorous as we can. But ultimately, you're still making a bit of a gut call on the opportunity and the entrepreneurs and things like that. So trying to get that balance right. And to me, the other thing was the middle market world, private equity. I look at the stock market now. That's all very frothy and very competitive. And to me, it's very exciting to be part of the ecosystem of capital markets where you're really creating these businesses for everyone else to get excited about. Then that the return for the risk, I think, is commensurate.
No doubt, no doubt.
Yeah.
Well, when you were first starting out in the early stage space, what did you have like a thesis in mind? You mentioned kind of going off gut, like, how were you making decisions then? And then how did that kind of like turn into the thesis for what eventually became Sandalphon Capital?
Yeah, so to begin with, my training wheels was I signed up for AngelList and signed up for a bunch of syndicates, and I could sit doing my day job and getting decks landing in my inbox. So I say you have to look at 100 before you pick one, because you just don't know what you don't know. And over time, there's definitely things which I sort of had a little bit higher conviction in based on what I learned in the past. I'm like, oh, this is kind of like this business, but earlier stage. I know a little bit about this market. This one makes sense. And then when I was starting Sandalphon, I basically went back. I think I made 30 small angel investments prior to Sandalphon, and I went back and looked at them. I was like, okay, like, what have I been doing? And categorize them, and I'm like, okay, we've done B2B SaaS. Okay, that makes sense given my background, and then come to appreciate regionally the Chicago and the Midwest is pretty strong in that. They did marketplaces, same. I would have said I didn't like hardware, but then I had done like 5 IoT businesses, and I think the hardware plus recurring revenue type businesses are interesting as well. And so the first fund was really just the broad lens of, okay, what do I know from the past? What have I been investing in so far, and what seems to make sense? And then we kept it pretty flexible. Given my background, I spent a lot of time looking at fintech, which then grew to insurtech and real estate tech or prop tech. That's sort of what I was getting known for. I don't want Sandalphon to be known for that, because we're sort of verticalizing as we sort of grow out the team. But those are sort of things which sort of aligned with my background the most and some of our early investments. And it would be going to like industry conferences and getting to know the specialist funds in that space. But it was, just sort of a loose a loose framework, and then just trying to refine it over time.
I love it. And you're very well known and respected in Chicago, but you're also, and we'll get into Midwest Tech Connect here in a second. But what you were in the UK, you were investing in these companies. It sounds like US based, Europe, maybe globally. What was it about Chicago that you saw? Maybe some of the characteristics, maybe both positive and constructive in a way.
So as a Chicago tech outsider, until maybe 2014, I honestly was getting on with my day job. I had no idea what was really happening here. And then I remember 1871 opening. I lived in River North at the time, and I'm like, oh, that's interesting. And then I started hearing about some of the early success stories in Chicago. But honestly, it's not very well documented and covered, like just how much has been happening. And I think 5 years from now, it's going to be very obvious that there's a ton happening in Chicago. But for me, culturally, I love Chicago and the Midwest, right? I'm from a small town in rural England. New York was a bit much for me when I go visit it there. But I love the energy, and I love people seem pretty nice and friendly and collaborative. So compared with the middle market in my former life, where it's very sort of dog eat dog, cutthroat, it felt like a nice place to be. And then just that intersection of opportunity and I guess my interests. I think for me to have quit my job and move to the Bay Area and become a VC, that would make no sense. But Chicago, it was like, okay, this is still an emergent opportunity. And the coastal funds, the more established funds, are definitely paying attention to the Series A and beyond. But this sort of pre-seed and seed layer where we like to play, it wasn't well served. And so I'm like, okay, let's lean in here. And I think people roll their eyes a little bit about how much sort of Midwest investors are revenue oriented, but I think that sort of, again, with my former lender mindset on understanding where the revenue is going to come from, it does help. We've invested pre-revenue and certainly earlier than many, but I think that the kind of businesses that are being built here are sort of pretty real robust businesses, like not sort of.
I would say revenue is probably a pretty important variable. I'm not putting myself in your shoes, but revenue or future revenue or predicting future revenue.
So.
Yeah,
it's not the only way to make money. I mean, I say I'm not really a tech investor. I don't invest in pure technology, right? I'm investing in like tech-enabled businesses, and that doesn't sound as interesting, but like really, that's what most investors are doing here, I think.
I love it. Well said. Now, talk to me a little bit about, we've talked about this, but just to give you an opportunity to talk to our audience, talk about Midwest Tech and Midwest Tech Connect and the need that you saw, maybe some of the pain points, maybe, and probably more importantly, the opportunity that you saw in the Midwest.
Sure. So midwest.tech was born last summer. And it was, again, a few things coming together. I spent a bunch of time the last few years doing laps in the Midwest. So I used to show up at if there's any major event anywhere in the Midwest where there was a bunch of startups or investors getting together, like I would try and show up there. And came to appreciate like lots of great things happening, but mostly focused at sort of the city or state level. And then as COVID hit, travel stopped. I think wanted to remain connected with everyone, even though I perhaps wasn't showing up as much. And people getting comfortable with doing the Zoom videos, some of the emerging sort of virtual event sort of tech platforms, kind of created an opportunity where I'm like, okay, now we can actually bring everyone together in one place. And I'm a big believer that the Midwest region as a whole is actually pretty strong, but it's lots of independent silos often. And I'm trying to create, and I'm not the only person doing this, but trying to create more connective tissue. And so Midwest Tech Connect was born. That was an event that we launched in July, took place in September. It was a pilot event. We had a team of 2 on it. It was pretty scrappy. We were building the plane while we were flying it, but we had 850 startups sign up, 280 investors. Through our platform, we had 3,300 connections made. Some of those we think did turn into investments. No one wants to tell us that though, but definitely some familiar names getting funded. And we're like, okay, this is a success. We'll do it again. We sort of look at the feedback, pretty good feedback, but everyone's like, okay, it would be great if you did X, Y, and Z. So we went looking for a different platform, and then we just launched that again a couple of weeks ago. And we've got I think 700 plus people signed up as of time of recording, and really excited to again bring everyone in one place. And that's probably the crux of midwest.tech right now is this Midwest Tech Connect event, but we've also been trying to activate more angels in the region. We're trying to connect entrepreneur support organizations, whether those are public, private, or nonprofits. We did a regional summit on tech sector economic development in December. We didn't make a big splash about that, but we had 100 folks come and 30 presenters basically talking about what was happening in their cities and states and really sharing challenges and ideas they had around sort of capital, talent, and innovation. So again, multiple layers of connective tissue we're trying to build.
It's so interesting, and I love just talking about. We talk a lot about on the show. Hey, Silicon Valley's 20 years ahead of us, and what does that mean? Well, they've had an ecosystem that's been around since like arguably the 60s. And that's kind of morphed into stuff over time. There's a lot of Lucas James talent partners. There's probably some version of midwest.tech that's for Silicon Valley. But I think you're right. Like, Chicago as an ecosystem has grown, and you could argue since 2014 over the past 6 or 7 years, pretty substantially. You might have Indianapolis have their own little thing. You might have the University of Wisconsin-Madison have their own little thing. You have some angels that operate at a University of Illinois. But yeah, if we're not all talking together and supporting each other and sharing ideas and networks and vendors, and it's just going to continue to operate in silos. And I thought that was really interesting, and I think you're at the forefront of that. It is a little bit of the wild, wild west, and up to folks like you to come up with ideas like that. I think that's great.
Everyone's trying to solve the same problems, and everyone's trying to get investors to come to their particular city or state, and and it's working. And like, we were exactly doing just that. But the critical mass, if you can get everyone in one place, then everyone will show up. It's almost like a marketplace instead of an event. And yeah, I'm bullish. Same with talent. Trying to, any individual city trying to convince people to move from the Bay Area there. Like, again, it happens, it works. But I think if the Midwest region sells itself, it's geographically contiguous, it's culturally homogenous. I think not completely homogenous. There's definitely some differences, but I think if you make the region attractive, then people, will come back and start thinking, okay, well, I have family there, and if it doesn't work out there, then maybe I can move to this city. And I think I'd like to reframe things a little bit regionally versus, people talk about the Bay Area, right? It's not in individual cities.
That's true.
Within the Bay Area. Yeah,
that's true. That's true. I love it. Talk to me about, especially a guy coming from traditional investing platforms, private equity, real estate, stuff like that. Because that's been around for so long, that's kind of where the money goes, and the money goes into mutual funds and 401ks and the stock market. Talk to me about like the importance of activating angels and getting some capital from maybe some of the other areas to look at this early stage space and the importance behind that.
Yeah, gosh, we were talking about this on Clubhouse recently. I think it's a huge untapped opportunity for Chicago. Now, again, before my time, I think maybe 10 or 20 years ago, there were a whole bunch of people that did put money into a wave of venture funds. And it was like, just, I think .com bust or whatever, like a whole bunch of people lost a bunch of money. So I can appreciate why people are now a little hesitant to get involved there. From my experience, again, coming from outside the sort of Chicago tech bubble coming into it, my LPs initially were a lot of my former colleagues or folks I met, so bankers, lenders, lawyers, real estate folks. Now we're sort of increasing more, tech operators and former entrepreneurs. Like, so we're diversifying our LP base. But a lot of people had no idea. They never thought about venture capital, never thought about angel investing, had no idea what's happening in Chicago. So I'm like educating them. And I think everyone assumes that like when you're fundraising for a fund in Chicago, everyone's talking to the same people. But actually there's a whole bunch of folks that are really just not aware. Like the traditional media is not covering it. Occasionally a story will hit Wall Street Journal. John Pletz at Cranes does a good job covering like the big Chicago tech stories, but like there should be like multiple stories every day in every local and regional and national media about what's happening in Chicago, because then people will start to like take it seriously and pay attention. So I think it's a huge untapped opportunity to activate these folks who can write, there are a lot of folks who are accredited investors. They could write 5K checks, 10K checks, 25K checks, and really activate this sort of, especially at pre-seed, or, make it easier for funds to, raise in the region. So like those are like I think a big opportunity. And I think it's incumbent on everyone to really sort of keep yelling like what's happening in the space.
I also think it's a little intimidating if you're not part of the space or you don't know a guy like Jonathan or a friend that's doing it. And it's like, if you're used to other avenues for investment, like I remember like, what do you do? How do you go find a deal? Like, unless you know somebody or you're part of a group or something like that. It's very like it's an illiquid investment, but at the same time, the visibility into how to even like enter the space, like there's got to be some easy walls that could be dropped. And I know there's like, government regulations about accredited investors and maybe taking that away in the future to open up platforms for stuff like this that aren't as present now. But I'm a talent guy, but I'm a Chicago guy. I was raised here. I'm not going to move here. The importance of the tech ecosystem growing, not because of making people millionaires and stuff, but to provide jobs and just software salaries and account executive salaries, like feed into the restaurants, they feed into the housing market, they feed into other things, they feed into the service economy, and other professional services companies on the outset. Like it is so important to like drive the technology scene from that. And what I'm hearing from you, it kind of all starts with what we're talking about to like just kind of get some capital kind of going and get that engine going to get these companies to that next level. So they are producing revenue and they can become self-sustaining or they get acquired.
I'd agree with that. I mean, people talk a lot about sort of Chicago's fiscal health. Like, everyone's like, oh, the taxes. Like, we can grow our way out of the hole a little bit, maybe not fully, and to do that, we've got to grow the tech sector. That's going to be the growth driver for the economy. It's already here. We just need to keep pouring fuel on the fire. And I think, it's easy to say, well, taxes, but put some capital at risk and, let's grow some jobs.
And it's still crazy to me that there's so many barriers of education and, like where do I go if I want to invest in the sector without like losing all my money kind of deal. Like, I think there's a huge opportunity there for you that you've identified.
Well, yeah, so funny you mentioned that. So again, coming out of some conversations recently, Chris Deutsch from Lofty Ventures and I and a few other VCs, we're trying to put together Ezra Golston at Starting Line, Jeff Eschbach from Chicago Early, Samara Hernandez at Chingona Ventures, Sonia Nagar, Community VC, Troy Hennicoff at MAP. We're all now behind the scenes working on trying to activate these angels that we talked about. So we're going to, we don't want to start another angel group. There are angel groups out there. We want people to be aware of them and join them if they're interested. There are folks that are doing syndicates. And then there are folks like yourself that do individual angel investing. So, wouldn't it be good for the founders if everyone knew how to find all those people? What form this will take, TBD. We're starting with like a boot camp to help, onboard folks into angel investing that are interested. Hopefully that starts a bit of a flywheel where they bring in others. And then for me, if a company's too early, and we do pre-seed, but if it's really more like angel stage, instead of referring it to the same, 2 or 3 angel investors that pop into my head every time, if I can refer it into a pool of people, again, got to be wary of like legal risks around this, but like a lot of this is referral based. That's how these companies raise capital. So how can we create the pool and help people find that pool? Because I think if we can do that, then there's more capital available, and also just the months that it takes founders to network 1 or 2 intros at a time, rounding up 10 to 25K checks or 50K checks at a time. We have to change that to really like ignite things.
I was just thinking that, like, think about, like, if you want to find a opportunity that's a huge pain point that you could provide value to, like, think about a founder that what they should be doing 100% of their time is finding new customers, training team members, like finding their next employee. And I'll talk to a founder and they're like, all right, like, I'll talk to you in 6 months. I got to go on like a road show and travel around the country. And, thank God there's Zoom now and people are writing checks off Zoom, but that's a huge pain point. Like, it shuts businesses down and they become super stressed. And then on the flip side, like, they got to be good and they got to be investable and stuff like that. But like, there's money for everybody. And it's a matchmaking kind of thing that's just broken right now. I think you're spot on.
Yeah, I think we've got to grow the capital base, but also, reduce that time, because as you say, if a company's burning 10, 20, 50K a month as they're fundraising, like, the money that is being raised or the money that is being circled is just getting absorbed by that. So if we can, now the other end of the spectrum is sort of Silicon Valley mania, where, you can walk into a coffee shop supposedly and, like raise $1 million. Like, I'm not like, that's great if you're a founder. Like, I'm like, that seems pretty reckless and wild to me. Yeah. And I think, again, it can work out, but a bunch of people can lose a lot of money. And that almost is like, I think it's a happy medium where we make it easier for people to find each other. We find more people faster and we have more risk appetite. And I think that will get us really far.
It's interesting to hear you say that and I'm not surprised by this because I know a lot of the other VCs that you mentioned, but everyone's pretty friendly with each other. They kind of work together in some context. Like, how would you categorize like the VC community in Chicago? Because my competitors, like, we'll have a friendly chat every once in a while, but we're still competitors at the end of the day. How would you categorize your relationship with everyone else in town?
I think it's really collaborative. It's big enough now that I don't know every VC in town. I try to know at least one person at every VC in town. Yeah, I think at an early stage, like most funds don't try and do the whole round. Even at the extreme end, there's a couple of funds that try and have like a 20% ownership target. And so if the founders are raising $1 million at 4 million pre or 20 at 6, like they'll do pretty much the whole round. But for the most part, even those folks will probably let in a couple of co-investors. So even the ones that you think will do the whole round, like so most people though, I wish I had better stats on this. I think it's maybe at the low end 3, but usually like 5 to 10 funds are in every deal at a very early stage, right? Everyone's sort of trying to take a portfolio approach, and I think that's really good for the founders as well, because then you're getting multiple points of view in terms of expertise, LP bases and advisor bases to help people out with like connections or advice, follow-on capital sources, both within the funds and then their own sort of networks. So like, I think that's really healthy. And so you have to collaborate with everyone, because we're all gonna. I mean, I'm co-invested with tons of funds now, and like we're all in this together. Like as much as like there might be one deal that's like really hot that perhaps I don't get in on, there'll be another one. And again, if you take the long view, every other fund success or every other a company that I don't get in, that's going to be good for Chicago, and those people are going to go off and start other companies. And like it's a very different mindset. It is like the rising tide lift all boats kind of analogy, but it is more like that, I think.
I think that's great. Anybody that we have on the show is so pro Chicago, and it's obviously they're doing what they need to do for wherever they're spending their Monday through Friday. But the general theme is like, hey, let's get Chicago up and running. We want to be competitive. We don't want to lose talent to the coasts. I just think it's great to see that collaboration across the board. Switching gears a little bit. So a lot of our listeners are aspiring founders. Maybe they're doing sales now and they're coming up with an idea. Like they're current founders, they just started their company. Maybe they're at a later stage. But for the aspiring folks that maybe don't understand like why you need capital at the early stages, and why you can't, like my business doesn't need capital. It's a services business. It just kind of started with Tim and that was fine. But where does venture capital come in to the mix? Why is it valuable? And then you mentioned some aspects of the relationship capital that's there too.
Yeah, like not every tech company needs to raise capital, and when I tell founders that they shouldn't raise VC money, they look at me funny. But I think it's a tool, and it creates certain expectations in terms of where you should get to with the tool. There's a whole ecosystem of folks that are bootstrap SaaS founders, right? So you can do it without it, but it's a tool. Okay, so what is it a tool for? To me, I bucket it into two, right? So it's either R&D, so you're either spending a lot of money upfront, or like ahead of the next year or two's technical demands. And for a real tech company, I really think that's core. And on the B2B side, sales and marketing, and on the consumer side, typically marketing, right? So once you found something that's working, they say like don't raise venture capital until you don't need it. But if your unit economics are good or seem like they will be good, and you can sort of prove out that early on, then if for every dollar you're investing in sales and marketing, you're generating some multiple of that through customer lifetime value, then raising some money now and giving up 10, 20, 30% of your business to accelerate that is great, because you're just accelerating the compounding of the cash flows in the business, like purely economically. And so we know there's obviously other uses. In fintech, there's regulatory upfront hurdles to overcome, or security. There's certain specific things, but really it's R&D or sales and marketing. Those are the main levers. And I think early on, folks will assess what you've done with little to no capital. But it's more about, okay, if you've done that with no capital, what can you do with capital to accelerate? The other thing is how aggressive the founders want to be. sometimes you can bootstrap your way, and some people are very ingenious at bootstrapping. And if you can get all your customers prepaying annually, and things like that, then that's lots of great cash flow in the business up front. Or if you can pre-sell customers to fund development, that's another trick that I see people do. That's great. It's really a matter then of how aggressively you want to attack the market. Do you want to grind it out and are you going to be at this 10 to 20 years, or do you want to sort of really invest in sort of getting the product different and better than everyone else as fast as possible, and winning market share? And some people, they can have a lifestyle business that kicks off cash, and that's great. And some people can bootstrap a business beyond just a lifestyle business. I hate that phrase, but it's sort of the cash flowing one that doesn't have other investors expecting an exit.
Right.
But yeah, as I say, it's a tool.
We have a board advisor in our business, Jeff, and he had started a company in my space, recruiting firm, scaled it up over 20 years, no investors or anything like that. But one thing he said to me that really stuck, that I think correlates to a lot of tech companies, is he's like, Tim, you have to get like a core group of just salespeople. Like you could hire one, but if you can get 3 or 4, building a community, some camaraderie, and then getting the word out about what you're doing, pick your head up 2 years later and then see where you're at versus trying to do it yourself. And I think it's like what you're talking about in tech on steroids a little bit, because you and I see these companies that are just like, hey, they met with Jonathan 2 years ago and now they're at 150 people. It's like that actually happens. And there's some magic there if you can execute that right, to get R&D going, get the engineering team, get a good CTO in place, get your marketing rocking and rolling, get that sales engine rocking and rolling, get some good back office support. Customer success is taking care of customers.
Yeah.
And if you have an opportunity to do that, and that's your plan and you're cool with it, to your point, that's a lot where the magic happens. And I think that's what everyone's looking for and what you're searching for.
Exactly.
Absolutely. Absolutely. Well, I really enjoyed catching up with you. I know it's been a little bit, and I'm so excited for you with everything that you got going on at Sandalphon and midwest.tech. You have a midwest.tech Connect event coming up, depending on when this airs. But if anyone wanted to find you, find Sandalphon, or learn a little bit more about midwest.tech, where can they find you?
Sure. So Sandalphon's website is sandalphoncapital.com. You can find all about midwest.tech, Midwest Tech Connect at midwest.tech. We invested in that domain name. And you can find me on LinkedIn, Jonathan Ellis. Follow us on social at midwest.tech or Sandalphon Cap. And our DMs are open. We're pretty accessible.
Awesome, Jonathan. Thanks so much for the time. I'm sure we'll talk soon.
Thanks, Tim. Appreciate it.